great. Thank you very much. It's really my great pleasure to be back at NYU, and especially to be here for the Volatility and Risk Institute, which is, I think, just a terrific and very important venture. And I want to thank Dick and Rob for including me again. Let me just we have four distinguished panelists here. I'll get to them in a moment. I was struck by, for those of you that saw the cover of The Economist that just came out, only 1,361 days to go. So if you were, we're going to get there, maybe. Things. So, but before I get to the panelists, let me make two comments. One of them was essentially the same that I prepared for Don's first chart, and I just want to emphasize, as I did a moment ago, that the share of banking activity, let's just put it that way, in the U.S. financial system has stayed relatively constant, bumping up and down a little bit, a percentage point here or there, over the last quarter century. It did decline in the 1980s and 1990s. There was all sorts of structural changes, but since about 2000, it's been what Don showed in his first picture. It doesn't really matter how you look at it. And some of the pictures, you have to be careful at looking at the scale, because remember what the software does is it expands so that the thing fills the scale. But if you plot it, and you look and you say 1 or 2 percentage points here or there. So that's the first fact, which is the way I would put it is that banking is clearly alive and well, or at least it appears to be. And so the question is what we're doing. So I think that one way of addressing your comment, Ed, is that we're looking at banking activity, but the question is, where's the ultimate risk? Who are the holders of the ultimate risk here? And is that the same as it was 30 years ago? And I sort of doubt that. And so I think that's really one way that we can approach this. The second fact is about the number of publicly listed domestic companies in the U.S. And again, many of you know this. In 1996, there were over 8,000 publicly listed companies. Of course, 1996, I'm choosing the peak year, and I'm choosing a period for those of us that are old enough to remember this, where there were enormous numbers of IPOs and some very bizarre companies out there doing things that we wondered what their business model was, and we found out a couple of years later that there wasn't one. But that's another story. If you look today, though, the number is less than 5,000. So you're looking at not quite a 50% decline, but a large decline in the number of publicly listed companies. And at the same time, if you look at data on the number of firms with 1,000 or more employees, which seems like a threshold that where you would at least start to look for listings, that number has gone from 11,000 to 25,000 over that same period. So you're seeing growth in big firms at the same time that you're seeing a decline in public listings. So that's my second fact. But over the decade, obviously, private financing has increased quite quickly, and then public capital markets much faster. So there's a shift here. So with that as a starting point, I'm going to introduce you individually, and we'll go from there. I'm going to start with Bruce Tuckman, who's immediately to my right. Bruce is clinical professor of finance at the Stern School, so he's part of the home team, and he's an expert in fixed income and derivatives markets. I've known Bruce for a while. We've talked on a number of occasions. And he's also the author of a textbook on fixed income. So if you want to learn about fixed income, you can go and look at his textbook. Importantly, I think that Bruce was the chief economist at the CFTC in Washington some years ago. And he also was a managing director at several places, some of which don't exist anymore, so we won't list them. But anyway, so
my department didn't lose a cent.
Well, there's always collateral damage, but so you hooked your wagon to it, and here you are. But anyway, it gives me great pleasure to introduce Bruce.
Great, thank you very much. So yeah, so Don did set us up a lot for this talk here. It was just supposed to be a push of the button.
It probably isn't.
So on the, I want to start with the graph on the left, which is, now this is FSB data as opposed to federal Fed data. So I haven't had the same issues that you guys are having. First of all, this one is global on the left, and it does show that the NBFI sector has been growing much faster in assets from a global perspective than the banking sector. But if you use the FSB data for the US, you also get an increase in percentage terms, not just in dollars, so that the NBFIs are growing bigger in the US. Although, as Don showed, the US has always had a much bigger NBFI sector, and it's always been above the banks, but it's still, in the FSB data, has been increasing, reaching over 60% of assets by the early 2020s. So I'm going to hold the graph on the other side, which Don also kind of got to, but I'm going to hold that for a minute. And I just want to talk about a paper that I wrote with Volatility, who's another NYU Stern person, and Nicola Cettarelli, who's at the Federal Reserve Bank of New York. And of course, what we say is not necessarily the views of the Fed in any way. So we have the following conceptual framework that there are kind of three ways to think about the relationship between the banking and NBFI sector. One is what we call the parallel view. And the parallel view is really more aspirational than descriptive. And it says that banks, and Paul Volcker, who maybe you can tell us his views about this, but he would be the advocate of this view, that banks are supposed to focus on payments, deposits, and loans. And because those are so essential to the system, we need government regulation and government backstops for those. NBFIs, on the other hand, are supposed to focus on capital markets, and if they fail, they should be allowed to fail. Now, maybe that sounds odd in today's world to say that, but I just want to point out that's been embedded in United States regulatory framework from the 19th century. The 1860s, the National Bank Acts very much limited what banks were allowed to do. The Glass-Steagall Act was yet another attempt to try to keep NBFIs, banks out of securities underwriting. And as recently as the Volcker Rule, trying to say that banks are not supposed to do certain kinds of investment activities, and banks are not supposed to do proprietary trading except in governments and loans. So that parallel view, again, is something that people have an aspiration, but it's not very descriptive. Why? First of all, as we've already talked about, NBFIs are doing activities that are very much like bank activities. It's been mentioned already, and I'll say more about that later. And secondly, we don't actually let NBFIs fail when the time comes. So the great financial crisis is lots of examples of that. The repo market turmoil in 2019, through COVID and the pandemic and shutdowns, and also as recently as the 2022 with the Bank of England supporting the gilt market when the pension funds and derivatives markets there had some issues. So people instead turn to what, rather than the parallel view, they think of a substitution view, which is NBFIs are substituting for bank activities. And that's motivated, at least in part, by the lesser regulatory structure around NBFIs. And if this is true, that they're doing the same activities at banks, then it also means they can be systemically risky, cause issues, and perhaps should be subject to regulatory scrutiny as well. And I would just say that parts of Dodd-Frank adopt this view as well. As was mentioned, we have, well, I won't go into details, so you probably know that. So, ways to control the NBFI sector in Dodd-Frank. So, but we in our paper, we have a little bit of a different view. We call it the transformation view. And to set that up, I'll now turn to this right figure, which again, very similar to a figure that Don had put up, which shows that of bank business, the fraction of their total amount of loans, which is the red line, and the fraction of their total amount of credit commitments, which is the blue line, to NBFIs has been growing up over time, has been growing up quite a bit over time. So it's an oversimplification to say that NBFIs are taking away bank business because banks are lending more and more to NBFIs. Now, from other Fed data, we also show that from the NBFI perspective, a significant fraction of their funding comes from banks. So ABS issues about 10%, finance companies 15%, broker-dealers and equity REITs about 25% each, and the GSEs 35%. So the big NBFI sectors, from their perspective, are getting a lot of funding from banks. So now, to understand what's going behind the data and why we call it a transformation view, I'm going to give you a bunch of examples. I'll tie them together in just a moment, but let me just tell you, because I think the comments you've gotten earlier also, it really is throughout the system we're talking about, not just one industry. So banks have shifted from holding mortgage loans to making collateralized loans to mortgage REITs and to holding senior tranches of MBS. Banks have shifted from making corporate loans to making senior loans to private credit and holding senior tranches of CLOs. Banks have shifted from originating MBS, CLO, and other ABS to offering warehouse financing to non-bank originators. Banks shifted mortgage servicing directly to lending or sponsoring the CP of non-bank servicers. Banks have shifted from LBO financing to making short-term loans to private equity. Banks have shifted from providing credit lines directly to non-financial businesses to providing credit lines to NBFIs like private credit. And finally, I would love to spend a lot more time about this because I'm quite into derivatives, but we don't really have time. But with the mandate to move derivatives into clearing, banks have shifted their counterparty risk to derivatives counterparties to liquidity risk to helping entities get through the margin issues. So that was a lot of examples, but I wanted to show you that it's really a very broad thing of what's going on in the financial system. And I just want to say, what are the common features of all those transformations? I know they went by fast, but the common features were NBFIs hold the junior tranches, are moving to hold the junior tranches. Banks hold their senior tranches and give credit lines. And we think that can be relatively explained by the post-GFC regulatory efforts to squeeze credit risk out of the banks. So they're disadvantaged now in holding the junior tranches. And the banks maintain, though, the relative advantage of providing contingent liquidity. They have deposit franchises, they have access to Fed lending facilities, and there are explicit and implicit government guarantees should there be an issue. So these transformations, we think, can be explained that way. Now, an implication, which Don also led to, is that if we're right about this transformation views, that banks and NBFIs are going to become more and more interdependent. And this, of course, is contrary to the goals of the post-GFC regulation, which was to try to take NBFI risk out of banks and to insulate banks from the NBFI risk. But if we're right about the transformation view, then they are becoming more interdependent. And in the paper, and I'm not going to give details, but we have two empirical analyses where we support this hypothesis. One using S-risk, which is created by Rob and other people here, probably the Volatility and Risk Institute puts that out every day. So if you use correlation of S-risk between the bank and I'm sorry, some of you might not know what S-risk is. It's the amount of equity capital shortfall there would be at various entities in a large stress event. So you can show that the correlation of S-risk between the bank and the NBFI sectors is quite a bit higher now than it was before the financial crisis, kind of 65% before, up to 80 to 95% now. The second piece of evidence that we have is we show that you can explain the daily returns of individual bank stocks by the exposure they have to the particular NBFI sectors that they are exposed to, right? So if a bank is particularly exposed to an NBFI sector, its bank returns will reflect the returns of that NBFI sector. And that exposure turns most important with respect to credit lines. So if you're exposed with credit lines to a particular NBFI sector, the bank's returns will reflect that. So in summary, the banks aren't so much shifting risks, and businesses aren't so much shifting from banks to NBFIs as being transformed. So NBFIs hold the junior credit, banks hold the senior tranches and contingent credit lines, and as a result, banks and NBFIs have become more interconnected.
Thanks very much. Thanks, Bruce. I think we're just going to keep going here. To my right, we have Gustavo Schwed, who's professor of management practice, also at NYU, so another member of the home team, as I think of it. And he's a prize-winning teacher, teaches about private equity. Prior to joining Stern, which occurred, I guess, about a decade ago, a little more, Gus worked as an investment professional in private equity, venture capital, and large buyout firms, and lived and practiced in a number of different parts of the world, I will say, Europe, Latin America, and the US. He's a partner and managing director at Providence Equity Partners. He was the world's largest media and telecommunications specialist, and also worked at a number of other firms, most of which do still exist, And and so that's a yeah. So but anyway, we look forward to your comments. Thank you very much.
Sure. So I'll focus a little bit on the relationship between the private debt market and the private equity market, which is the market I understand the most. Private credit has been an enormous boon to private equity. It's a stable form of debt capital, much more stable than the broadly syndicated loan market that's sponsored by banks. So even today, when you have a lot of uncertainty and dislocation, you have these private debt funds making loans to leverage buyouts. The capital is available, and so that's very helpful. They've also provided private equity firms with bespoke structures for their debt. The debt structures tend to be a lot less cookie cutter because they don't have to be broadly syndicated or sold. And so that allows private equity firms to finance deals that aren't as easy to understand as in the broadly syndicated market. Private debt used to be the domain of smaller private equity deals, just because of scale issues. If you have a very large deal, you need the distribution power of syndication. But that's changing as well, as private debt funds have raised very, very large funds, and it's possible to do large leverage buyout, either by clubbing together a few of these private debt funds, or in some cases just by dealing specifically with a single one. And then I'd say that, well, there's been, at least until recently, there's been a lot of flexibility in terms of covenants. These loans have largely been covenant light with a few to any maintenance covenants. That's changing now, obviously. And then, you know, the other side of it is that the private equity firms own most of these private debt funds, or at least is defined by assets under management, if not by firm count. And that has just accelerated the asset gathering at private equity funds, which is very important for them as publicly traded firms. They really rely on increasing AUM, increasing the most stable form of revenue, which is the management fees. And that's allowed these firms to grow and their market capitalizations to grow very significantly, again, until recently. So it's really been sort of a gift from heaven for these private equity firms. Also for these pension funds and institutional investors, they've essentially created a new asset class for these private credit products. And at least so far, they perform very well when you look at the trade-off between return and volatility. So all of that's been very good news. So what I worry about are things that have been mentioned, and I'm sure will be mentioned throughout this conference. One is the participation of insurance companies in the private debt market, and specifically the fact that increasingly private equity firms are acquiring insurance companies and kind of repurposing or reallocating their capital so that they're have a heavier participation in private debt and in alternatives in general. So that's a little bit of the fox being in the chicken coop once these private equity firms get their hands on these insurance companies. The other is just the fact that we don't really know how these private debt platforms are doing because the valuation is so opaque. So, you know, the GPs have discretion over how they value these companies. There's some accounting guidances, but they still have a substantial degree of discretion. So, you know, until there's a real stress event, we're not really going to know whether these valuations were the right valuations or not. Thirdly, competition between the broadly syndicated debt market and the private debt market. So today, the syndication market for private equity is largely closed, but it had been closed a few years ago. It had been reemerging last year, and that reemergence means that for many deals, the two markets are competing against each other, and you see spread compression as a result. And a potential erosion of underwriting standards. And then the final thing I'd say is that a lot of the loans or in the participation of the banking sector in the private credit market through these loans by either leveraging the private debt funds or by extending NAV loans, these are structurally subordinated loans that you know, are very risky. They the first claim will always be with the credit at the portfolio company level, and only to the extent that liquidity is allowed to flow up to the lending platforms will these structurally subordinated loans be serviced. So I think that's where I see the risk.
Thank you very much. that's really interesting, and I think certainly something that at least I don't really know much about, so that's great. Next, we turn to Jim Milsey. Jim is the co-chairman of Guggenheim Securities, investment banking and capital markets business, and he's a veteran of the U.S. Treasury Office of Financial Research, so that puts him in with some other people.
He was actually in Treasury.
Oh, he was in Treasury?
Yeah. Yeah.
Okay, all right. Okay, well, excuse me.
It's all right.
Get that wrong. But he's an expert in restructuring, a member of something called the American College of Bankruptcy. I kind of like the name. It really does bring up sort of good images. You sort of wonder what they're actually doing there, but we'll let that go. But anyway, Jim, the floor is yours. Thank you very much for being with us.
Great. So I wear a couple of different hats. I teach a course at Columbia on private capital. I sit on the investment committee of a small private equity fund, and obviously sit on as the co-chairman of Guggenheim Securities. So we place both public and private securities. And so I've got a kind of couple of different ways of looking at this market. One, but in the academic guys, no, in the private capital, clearly the growth of the private credit markets has been in tandem with the growth of the private equity markets. And, you know, you mentioned the stat that there were half as many public companies today as there were 20 years ago. When you look at the public markets, of those 4,000 publicly listed market companies in the United States, about 1,000 have revenues in excess of $100 million. You look at the private markets in the United States, privately owned companies, there are about 10,000 that have 100 million or more of revenues. And that's the feeding ground for the private equity business. I can tell you from my experience sitting on as the chairman of an investment committee of a small private equity fund, probably 80% of the deals we do are actually acquiring family-owned businesses in the third or fourth generation, where that generation has no interest in managing the business, but rather managing the money that the previous generations had bequeathed to them. And so the private equity business is actually performing, I think, a salutary function for the U.S. economy as a whole, which is to professionalize the corporate sector, the small business corporate sector, bringing in, you know, management talent, but also bringing in leverage. I would say in, you know, 60% of the companies that we acquire from families have no debt. They may have a standby bank credit facility, but they have no debt. Obviously, when we pick them up, we're levering them up 3, 3.5, 4 times, and then managing that debt till our exit. I think we're about to have a big stress test as a result of the trade wars of this middle market, lower middle market business sector. There are the companies that are dependent on imports from China. Their revenues are they're done at 145% tariffs. They're not buying anything. The companies that are dependent on intermediate inputs from China are scrambling right now to find alternative sources of supply. In talking around with my brethren in the middle market private equity business, this is true across the entire landscape. And although Gustavo talked about, you know, what I think the sector you were talking about is kind of the commanding heights of the private equity and private debt markets, the Apollos, Blackstones, KKRs, those who have gone public and are asset gatherers. Where I operate, we're actually kind of doing deals. We're trying to gather assets, but we're very much dependent on the private credit market as sources of financing for our deals. Question is it what's going to radiate out of the defaults in this sector? Because there will be defaults in the sector as a result of this trade shock, unless the president wakes up tomorrow morning and changes his mind, as he's apt to do. There will be defaults starting, not just because of the wall of maturities that Ed writes about. As you know, the massive wave of refinancing that went on in the post-COVID period as a result of what the Fed did with interest rates. Generally, in the corporate market, debt terms are 5 to 7 years. So that debt that was raised in 2020 and 2021 is now coming due in this next 2-year window. So we've got a huge maturity wall confronting a huge shock. And the question is the private credit world going to deal with that shock differently as a result of the fact that their capital is locked up? And I think the answer is generally yes. When you look at there's much less run risk, and the fire sale mechanic that radiates out into the rest of the world is going to be more limited, more muted, in part because of the lack of transparency, and in part because of the nature of the funding that these private credit funds have. That said, the private credit funds are not infinite. Most of them have lives of 5 to 7 years. And so depending upon the vintage, there will be pressure from limited partners to get out. But when there's no exit, there's no exit. And unless there's another lender ready to refinance them, they're stuck. And most of these funds are structured to have 1, 2, 3-year extensions that the general partner can put to the LPs to keep them captive. I think one of the other development over the last 2 years, and maybe in anticipation of what's going on, not obviously in anticipation of the trade shock, but in anticipation of this refinancing risk and the large maturity wall and the life of the funds coming to their term, is a rapid development of a secondary market in limited partnership interests in both private credit funds and private equity funds. I can tell you at Guggenheim, this is one of the most rapidly growing parts of our business, where we're just acting as a broker-dealer, creating markets and limited partnership interest. There are, again, this is something we do in America to fairly well, or at least in the finance system, funds on funds on funds. So there are special funds that have been organized to buy these LP interests. These are, fund of funds. And they are a source of supply. That's both a source, the LPs are a source of supply. These fund of funds that have been organized to buy these LP interests are a source of demand. But again, I think the shock we're about to go through is going to create enormous valuation uncertainty, both for the private credit assets in these portfolios, as well as for the private equity assets in these portfolios. And so that the liquidity provided by this secondary market may dry up pretty quickly. So how that radiates back to the banking system, I leave to you guys to describe those linkages, but it's pretty clear that the banking system is going to feel that shock too.
Thanks. I guess we're getting more and more depressed as we go through the morning.
I'm a structuring guy.
Right. No, right. I guess, yeah, right. No, you'll come into your own very
Exactly.
soon.
No.
There you go.
So
So I
much
guess
time.
this is for some people, it's an opportunity. Our fourth very distinguished speaker is Hugh Van Steenis. Hugh's vice chair and partner of Oliver Wyman. He also serves as a member of an investment committee at the Oxford University Endowment. And I was interested to see that your you're also involved in the English National Opera.
Yeah.
So I think that from my perspective, I know about you from what was called the Van Steenis report, which is entitled "The Future of Finance" and was published in 2019. So here we are. I guess we now know a bit more about the future, that future in any case, and I guess we're not here for a postmortem on that report. I don't think so. Unlike what Don so nicely did for us earlier, but we're anxious to hear your views on how finance evolved since then and where we're going next.
Thanks a lot, and delighted to be at NYU. You probably should have said that the person who commissioned the report went on to do something interesting. So Governor Mark,
well, I wasn't
clearly
gonna...
got an interesting role, and I'm very much hoping this weekend he might be the next, the elected Prime Minister of Canada as well. At the moment of the shock, and we'll definitely talk about the shock.
Oh.
Look, so I love Bruce Farrell and Nicolo's paper, so I thought I'd start saying, where do banks end and where does private credit begin? And I think for this conversation today, I think there's sort of three competing narratives. So the first is the simple one, which is it's all about disintermediation. The poor old banks are losing share. And I actually think that model was actually quite helpful post-GFC, and in particular post-2012, when the Fed issued guidelines around leveraged lending. And there, it's what Charles Goodhart would call the boundary problem. The boundary shifted, and actually private credit benefited enormously. And we created, particularly stateside, $1 trillion parallel system, in that sort of 14, 15-year period. I think the second narrative, which is teased out of Bruce and colleagues' paper, was really that this is not debanking, it's more about the retranching of the banking system, where banks are parceling out the junior slices and retain the senior. And I went a little bit more prosaic than I said in the FT that private credit will be likely the new Ozempic to help banks shed more weight. And I think that going into a situation where the former Vice Chair's vision was hoping for a 19-20% increase in bank capital, that was very real, but clearly that's now changed. So I think the third narrative is then really that private credit is actually about parceling up assets, and it really is private label securitization. And actually, it's not so much competing against the banks, it's actually changing the nature of securitization markets and bringing them more private, and in particular, picking off some of the non-bank financial markets. So in some ways, what Apollo or KKR are doing is recreating a GE capital model, but with, as Jim just said, with a much more secure funding base. Now, like any sort of narratives, there's truth in all of them, and there's failure in all of them. And I think, as the panelists already said, some of this is a problem about segmentation. Because this market now, whether it's 2, 2.5, or 3 trillion, depending on how you slice it, is very segmented, and I think it's got bits of each. Stephen, can I ask you to do just one slide? So I think it might just be helpful to share that. Oh, actually, okay.
This one here?
Well, I'll do this one, and then the one I want to use. So just to put it in context, as we all know in this room, bank disintermediation has been going on for over 50 years. And I would argue that disintermediation today is actually far less profound than what we saw in the 70s, post the Nixon shock, and so forth. Now, I'm happy to go through maybe in the Q&A a little bit my sort of theory about these waves of disintermediation, but there was a shock, there was a series of financial innovations, the existing regulations constrain the banks, and therefore it's easier to pick them off, and then the new regs post-shock reinforce the disintermediation. And I think the early 70s to 80s, Reg Q clearly was disadvantaging the banks because they couldn't put up interest rates. The innovation was money market funds. CP then drained out of the banks to markets and so forth. So I think what you've got is waves, but like with waves, they're not unidirectional. They do wax and wane with the credit cycle, with the economic cycle, quite frankly, with the capital and the banking system. And what I'm arguing here is that private credit sort of 1.0, it was sort of post-financial crisis, obviously existed pre-financial crisis, but it was turbocharged by the GFC. And therefore that following 14, 15 years was really about mid-market and left-in and acquisition finance. And what we're now seeing is much more about specialty finance and a little bit commercial real estate too. I'm sorry, I'm in charge now driving. So this is the one bit of data, and I won't use any more slides. So how is the market changing? The official Preqin data you get, which BlackRock spent $1 billion on,
Yes,
it's not that great. I'm sure they'll improve it because they're a very smart and an entrepreneurial group of people. So what I've done is looked at the top 7 listed firms. By what I did say is by heritage, I was a 20 years a stock analyst. As a young boy sitting at the foothills of when Dick was the chief economist at Morgan Stanley. And what I took is the 7 largest firms, and I took all their credit assets. So not just what they define as private credit, but also infra debt and real estate debt. Because I think another thing going on here is the large firms are now saying, I've got a continuum of debt solutions from low to high risk. So 1.3 trillion, 2021, it's grown to 2.3 trillion at the end of 24. Back then, insurers provided about a third of the capital, and it's now roughly 42, 43%. So put another way, over half the growth in private credit in the last 3 years has come from insurers. So this is particularly providing credit assets to annuity providers. These annuities, as Jim said, the whole panel said, these are stable sources of capital. You know, we can argue about redemption rates and but on the whole, these are sticky pots of money investing in credit assets. And in fact, if anything, the ALM's the wrong way around. The assets are buying a shorter duration of the liabilities they've got. So there's as ever in life, there's never any zero ALM, but it's probably the wrong way around ALM. So of course, with that innovation, the private credit firms are themselves pivoting to try and create the assets to sell to insurers. Now, some of this is because the annuities providers are looking at the success of Apollo and wanting to copy. So there's a little bit of emulation. But there's also kind of need must. Because, you know, once there was a binge of private equity buying in the pandemic, you know, when it became clear there was when we got the vaccines were coming, it's become the interest rate shock we saw meant that basically left in was a modest market. And so they needed fresher pastures to go for. And in particular, now it looks like the banks are not going to be regulated as much. There's huge competition around acquisition finance, and everyone's struggling. And I agree with Jim, the shock I think is a very profound one. The firms I'm talking to are now saying maybe it's not till 2027 that we actually get a pickup in M&A that we were hoping for, or IPOs. And in which case we need to be very innovative and fleet of foot to try and, you know, reparcel some of the risk, whether it's secondary debt, whether it's providing different sources of finance. So I think that this change means that this private level securitization is a much bigger deal. In the States, there's about a $5.5 trillion specialty finance market. We reckon about 2/3 of that comes from banks, but 1/3 is non-banks. And this could be agricultural leasing, it could be aviation finance, it could be data centers, but it's basically hard assets. What I'm intrigued by is that the practitioners now need to go from scrubbing 200, 300 companies to get a loan portfolio of 29 credits to now securitize pools of debt, which require very different ways of analyzing. And so there's a flurry of talent moving from the banks to private credit to try and actually upgrade that skill set. But I think there's a question earlier on about then, well, what's the mismatch? So what I put on here is that we estimate, and let's be clear, these numbers are a little bit, don't take these as hard numbers, roughly 10% is now to the wealth and retail channel. Now, there's a huge hoopla in the media that this is the next wave, and you know, potentially there is an opportunity set, particularly if there are changes around 401k. I personally think it's actually a legal shield to sell into 401k is what we really need, rather than just the package of the right envelopes. But within that 10 points, 9 of those 10 points are BDCs. So our estimate is probably only 1% of private credit is in interval funds, and that might even be high. So it's much, all the hoopla, all the chat, it's a much smaller problem in my view, and therefore it's much more about trying to think through the changes. I'll make one last comment before passing on. I think there's a question to Don around working private credit. So if I borrow numbers from my good friend Thorsten Slock, taking 2010 to 2023, so we'll skip a year, bank loans are up 5.5 trillion. It was US data. The IG market was up 5.5 trillion. High yield was up 0.5 trillion, and private credit up 800 billion. So let's be clear, it is a growing sector, and like incrementally, it's growing fast. But actually, the IG market is there. And so actually, my final comment would be, if you're sitting there as a private credit firm or private market firm, private equity looks like at best it's rolling over, but I'm slightly more in Jim's camp, there's a shock. Then actually, and on that, I think the biggest conversation I see from our clients, which isn't necessarily in the media, is that the working capital squeeze on US retailers, particularly small retailers, is abominable at the moment. It's truly abominable, and all the orders are therefore cancelling because you can't take the hit of the tariffs.
Right.
I don't think that's fully picked up. Maybe it's drifting in with now looking at how the amount of container ships to LA are coming down. But if you're sitting there saying private equity is not growing very much, I need debt. Well, lev fin is not going to be a growing category either. I need to find something else. Actually, trying to bite off a bit of the IG market or bite off a bit of the securitization market actually looks quite an interesting way to go.
Thanks very much. And thank you very much for the numbers that put this into perspective. I think that the last bit I particularly I particularly like, because I think that my own impression of this is the numbers just aren't very big yet. Maybe they will become big, as you point out, but you know, this 10% number here on your picture, which is only $230 billion. My threshold for big was always what Elon Musk's wealth was. It seems to vary too much, and I should probably not use that example anymore. But this doesn't rate then by that standard, and so. Anyway, well, thank you all very much for those tremendous introductory comments. I think I have a couple questions that I want to ask, building a little bit off of some of what's going on in the world and some of the comments that were made earlier, and then we'll open it up. We have I think until 10:15. So my first question is about the what looks to me at least like the sort of retreat from globalization, shall we call it, trade and finance. A lot of the activities, the structures, the firms that you're discussing have global footprints. They have cross-border business models. They have investors that are not all that are all domestic within a particular border. So my question is whether or not these things are at risk as a consequence of financial fragmentation as much, or what the consequences you see to financing of non-bank financing. Bank financing can probably survive some of this a little bit better, but non-bank financing comes from that. So we can just go.
Well,
Do you want to
I
start,
can
Jim, and then
jump in
maybe
on that. I
Gus, and
mean,
then-
there, as a result of the tariffs and real hostility that the Trump administration has expressed virtually the entire world, there is a real freeze on foreign investment into the United States, and probably an exodus underway. We saw that last week and the week before with the decline of the dollar and the yields moving up in the 10-year. But in talking to pension funds, institutional investors in Europe, there are large needs here. 4 months ago, the AI boom, was producing a huge surge of investment in data centers. That's frozen to the extent that the capital is coming from Europe or Asia. And so there is, and I think across the board, corporate leaders have no idea what to do. Everyone, I can tell you, in the lower middle market, people are scrambling to try to protect their liquidity and shutting down operations that are dependent on imports that they can't afford to buy, and trying to figure out how they're going to weather the storm, and the assumption that the president is going to ultimately give it up, because the economic damage is going to be widespread and deep. And the guy likes to be popular, so presumably he's going to change tack eventually. But the question is how long. But I think the ramifications for the multinationals are different, in that they may become victims of retaliation. We see Europe starting to go after the MAG, whatever they are, 7, 5, 10, with fines, and I'm guessing that's going to accelerate until Trump relents, so that international exposure for American businesses, I think, is a vulnerability.
I just building on what Jim said, I think it's an intriguing theory that maybe the boom in private equity and private credit was really a strong dollar play. And actually now, for the rest of the world, without a strong dollar, there's no interest. In fact, many of the private equity firms are now being asked for hedged share classes. They haven't seen that ever. So they need to now do from a place a Canadian dollar hedged asset class, right? Private equity hedged. How do you do that for a 10+2 fund? So you probably end up doing a dollar Canadian denominated fund rather than a global fund. Let's be clear, the same for Europe. So we're early days, but I think the level of pressure to repatriate, and that's on top of the fact that my old boss, Mark Carney, hopefully, well, let's be clear, the make-late are going to have to do their national duty. The European funds the same for rearmaments. There'll be investment assets domestically which they do need to finance. Protect now. Will they be attractive enough? Will they be the right tenor? We can debate. But the need for sort of national duty at a time of weaker dollar, I think, is very much there. So I think we can debate what are the ramifications, how long this takes. I penned a piece in the FT last week arguing that this shock is as big as the Nixon shock. Now we can have a bit of fun with that, over coffee. But I do think this is very profound in terms of the ripples for major asset owners.
I do too. Gus, did you want to comment?
Well, I agree with what's been said. I think we're facing a potential catastrophe, at least in private capital. The private equity firms are frozen. They don't know how to read the situation that we're in today because it is unprecedented. So they're not used to trying to figure out how their portfolio companies could adapt to changes in trade. And we have to remember these are highly leveraged businesses. So you mentioned 3 or 4 times, the average leverage multiple 6 times in LBO. So it doesn't take much in terms of disruption in asset values to have real problems. Now, during the global financial crisis, you had of course, a very deep crisis, very different reasons, and the industry survived very well. But that's because the lenders gave covenant waivers and extended maturities. Remains to be seen whether that's going to happen today. It also has to be said that the private equity industry has been in semi-crisis mode for the last couple of years as it is, because of illiquidity. The IPO market and the M&A market have had a lot of issues in the last couple of years. Private equity firms cannot exit their investments, therefore they cannot return capital to their limited partners. Therefore, the limited partners become overextended in private equity because they're not getting distributions back. They're allocated. If you look at the Princeton University, just because I happen to have looked at this endowment, they're at a little over 40% in private equity. Their policy goal is, I think, 25%. And that is the situation at many or most institutional investors that invest in private equity. So already private equity was having problems. The performance basically they've underperformed the stock market benchmarks for the last 7 years after a spectacular 2021. So how all this compounds those problems, it's a really unique situation in my I don't know, 25 years or now 35 years observing the industry. I don't think I've ever seen anything like this, and it's very difficult to predict how it's going to play out.
Yeah, just and as a restructuring person, there's a parallel between how workouts were done in the 80s with how workouts are done in the private credit. In the 80s, it was basically your creditors were banks, and there were banks then had workout officers, and you would sit with your bank workout officer and extend and modify and downsize the loan with asset sales and the like, but it was basically a bilateral conversation. And now, you might have had a syndicated loan with a bunch of participants, but the agents were very strong, and it was basically a bilateral conversation, lender to borrower. In the private credit, private equity, at least in the segment we're in, the lower middle market, maybe you have 1 or 2 private credit funds. And they don't really have an exit. There's not a market for the loan they've made. So it's kind of similar to what was going on. It's mostly a bilateral conversation. The lender is very supportive of finding a solution. And the only limitation on that is the life of their fund. For lenders that are hitting, the end of if it's 7 and 2 or 7 and 3, if they're at the end of the life of the fund, they're a little more difficult. But if they're inside the life of the fund and the restructuring can be negotiated, structured within the life of the fund, you're likely not to have, a huge wave of defaults and fire sales, because there's really no market for the sale of a small $50 million, $75 million loan.
So I guess you're making me feel better about some things, again, worse about others. Better in the sense that maybe the administration's going to get what they want out of for the current account by actually shutting down the capital inflows. But well, it's not great for the economy, but at the same time, we're not going to see an actual emerging market sudden stop where you have to turn the current account deficit into a current account surplus. So I'm not sure that's better, but it sort of seems a little bit better.
Can I just add one thing? Just a
Sure, please.
question I have about this, how workouts and restructurings are likely to proceed in a market that's dominated by private credit instead of banks. I agree with what you've said, and I do think that it's in the interest of these funds to be constructive and to try to find solutions. What's missing, though, is the fee relationship that the private equity firms have with the banks. In other words, that gives them a lot of leverage against the banks. Big private equity firms pay hundreds of millions of dollars, if not over $1 billion fees to the big investment banks. And if something goes wrong with the portfolio company, that gives them a lot of leverage in the restructuring. Now, the counterparty are funds that are very much like they are, and who will protect their LPs and who may not have the same sort of relationship concerns. It just remains to be seen, because we haven't had a stress cycle whilst this private credit market is so dominant.
Why don't we open it up? Hugh, did you have something?
No.
Okay, thank you. Okay, we'll start with Nat and then Ed. I think we need, we're actually streaming, and then right there. I think we're streaming, so we need to make sure everybody has a microphone. Nat, please.
Right. Can you
actually identify yourself first, please?
Yes. So I'm Nat Benvin from the Bank of England. Thanks very much to all of you in the panel. That was really interesting, and I very much agree with much of the assessments that you've just had collectively on that ecosystem. My question is for Jim. We talked a lot about the opacity, the fact that it's difficult to work out valuations, who's related to what, the degree of leverage on leverage, etc. So given that, although it's pretty easy to get a good picture of a refinancing wall on the public side of things, where they are, how big they are, and how they get pushed or not pushed, how do we work out the size and the timing of the refinancing wall in the private funding market?
Should we take a few and then we'll come back around? So Ed Altman, and then
So
please the microphone and identify yourself, please.
first of all, Ed Altman from NYU. I think your comments are absolutely perfectly clear and difficult. I'd like to ask the question with respect to how transparent are we today and will be in this stressed period with respect to the defaults, recoveries, losses on the part of these portfolios, when most of these are private funds. If you deal with the BDCs that are publicly traded, they have to report to the SEC, and you can get pretty good data on defaults, even though a lot of the extensions will be in. So to give you an example, last year, the data I've seen, the default rate for BDCs private was 1.9%. They make floating rate loans, they're collateralized, okay, so the recoveries may be fairly high, but they're still junior in many cases. The default rate on bank syndicated loans last year was huge. It's kind of under the radar, but the default rate on floating rate loans to banks was close to 6%, which is twice the historic average. So we've got same kind of loans, same leverage finance companies, maybe even worse with respect to private credit, but much lower reported data.
But on the BDCs, look at the growth in PIK interest.
Yes.
That's
I'm gonna get to
the
that.
telltale sign. That's the
Yeah,
canary.
exactly. Payment in kind, by the way. So it's a way of, instead of paying interest, you pay more debt. You
accrue the interest.
It's a great point. So this, for Jim and Gustavo in particular, and maybe the others, how are we going to know on a timely basis the pain that might come out of this next couple of years, the maturity walls, et cetera, on private credit, private funds, which somehow, have a difficulty in seeing their results, except maybe when they actually fail, then we'll know it. So the whole question of transparency of the risk factors and therefore the stress testing that can be done.
You want to go first?
Here.
No, we got more questions.
Take one more and then we'll come back. Second round.
Hi, I'm Wilson Irvin, currently a private citizen, most recently working for Nelly at the Treasury. A question for Jim, but also for the panel. Jim, you've done some amazing public service work, but I want to appeal to your restructuring opportunist side. If you were setting up a SWAT team to look for trouble where there's going to be the most restructuring, Hugh pointed out, for example, the retail industry, where would be the places and timings or regions that you would say, these are the places that are going to be hit most by the intersection of financial walls, tariff troubles, or anything else? Where would you see the biggest opportunities as a restructuring person, or the biggest threats if you're everybody else?
Yeah.
Okay, let's go down the. I don't know. Well, Jim,
I'll
you
answer
can go
that
first,
question.
and then
I mean, it's trade intensive sectors, right? I mean, anybody who's got exposure to trade either in their intermediate input or the actual final goods they sell is going to be, going to have trouble, is having trouble right now. You just look at Hugh mentioned this, we both got this from Torsten, I think.
Yeah.
The number of cargo ships on the water heading towards the United States is down 50% in the last 3 weeks.
Yeah.
So, if anybody who's dependent on what was in those cargo ships is in trouble. So it's really trade impacted. But the wall of maturities is less important right now than trade intensity of a given business.
Can I just say, so my sense is the stress is the smaller the company, an Amazon reseller, you can definitely pick up less stress. Obviously, some of the private credit funds aren't really doing factoring and collateral management for the working capital. This is a working capital squeeze, or in case it's being crushed. And if you take I know you've got a 10 million order to China, you now need to pay 24 million working capital to get the goods out of bond. So there was a little bit of pre-ordering by larger firms. In fact, one anecdote I picked up is some of the smaller firms got bumped, a bit like in COVID, where the larger firms said, I need to rush this ahead of the
Oh, yeah.
and so the smaller firms then got bumped and then got absolutely whacked by this. So I think it depends on what, if you're a toy reseller from China, wow, you're
Done.
crushed.
You're
You're
done.
done.
Yeah.
So I wouldn't buy those. But any phrase. But but maybe the larger company, but this is the thing about how much you can hold your breath for. And I think that's the interesting question is you need to get quite forensic about the level of quite granular. Sorry.
yes.
Well, I think that regarding the question about how do you know what's, how much distrust is already in the system, if it's a system that's largely private. I guess my best answer is you don't really know. There's no real way to tell. A lot of these private debt funds are owned by publicly traded private equity funds who mark these portfolios to market. And, you could look at the Blackstone 10K and you could see what their NAV is for all these private credit funds, and you can do that with Apollo and all the others. But that relies on their valuation techniques, where they have wide discretion in terms of how they value these things. And they may have fund management issues that drive those valuations. Usually when you have a correction in the market, private capital managers are slow to adjust their valuations. They may be entering the fundraising stage and they don't want to show poor track record as they're fundraising, for example. So honestly, I don't think you really know. You could look at the discounts at which to NAV at which BDCs are trading at, I suppose. But I think we're going to find out the hard way.
Well, I for that, I have two suggestions. One is there is a secondary market in private equity LP interests and in private credit LP interests. So looking at the discounts to NAV in those trades is one way to get insight into where the portfolios are really marked. And the second is all of the various public pension plans who are investors have, annual disclosure at least of the valuation of their assets. And so that's another public opportunity from public data to find information on where things are marked. Dick and I have had many conversations about this. The Office of Financial Research really needs to step up.
And there's one of the legislation. I was about to say, there is one of the sources, which of course the assets which are backed for insurers. You can get that through the Bermuda regulator, through the Cayman regulator. Obviously, the assets they bought were clearly IG when they bought them. So they probably aren't the first ones to turn sour, unless you never know. There will be some shocks in the system there, but they will be of a probably higher quality than the canaries will be sort of the mid-market finance, which is less than us.
Comment well taken in terms of the extension ability of these loans, the PIK option, which I've heard has increased a lot. The exact amount, I'm not sure. Yes, you can look at insurance reports, you can look at reports of the publicly traded BDCs, which is a very small percentage of the total assets under management. Is there someone actually doing this and doing this on a comprehensive basis in our system? Or is it something that you could do? And maybe that's for us to do as well in terms of research.
Let's take another round of questions. Jill up there, and anyone else raise your hand, and I'll have you more. Nellie, okay, and.
I wanted to ask the panel your thoughts on whether it's time to do an economic impact assessment on the leveraged lending guidance for banks, and whether we have perhaps created more financial stability risks than we intended with that guidance, because now we've made it less transparent what's going on, and we've hyper-financialized through banks providing liquidity commitments, which you can see in the shared national credit data, to non-bank financial firms. So curious to hear the panel's views on it.
Thanks. Nellie?
Hi, Nellie Lang at Brookings now. I've sort of a, framing question. It was just a comment on your broad paper, which I think is just terrific, where new banks and NBFIs, where they start and end. Can you hear me now? So just, you mentioned Volcker's view of a narrow banking that's payments and loans and deposits and core to the system and critical, and then the NBFIs are out there. And in your view, do you think that's still the right framework? We are having this growth in private credit, some at the expense of banks, but the banks are just taking a different tranche. Are we better off in this new system, or do you think it's, a fundamental problem?
Thanks. Let me just add to that a little bit, that I think that when I was listening to you first, Bruce, if you'd come to me in 2009, 2010, when some of us here were trying to write new regulations, and you'd said, oh, this is going to move a lot of the higher risk tranches of this stuff. Yeah, it's going to be retranched, but you'll move the higher risk tranches off the balance sheets of the banks into these other things. These other things are generally, at least at the time, not as highly leveraged. They look like they're more equity financed. I would have said, oh, that seems like a pretty good deal. Well, where's the problem? But now I'm not so sure after listening to you. So anyway, let's see what people think. You wanna?
Yeah, I'll take a first shot. So I don't think I've ever been in the Volcker camp that way. I think, you have to let markets, you have to let markets do their thing in providing the value that that they're providing. But we have all of these ways in which the entire system reshuffles to kind of reduce the, make the regulatory pressures easier. So, there have been a bunch of papers like Mervyn King wrote his book about that, and Bill Nelson has written a proposal. I wrote something a very long time ago about trying to get banks to pre-position collateral against exposures to non-banks. And it's the discipline of having to do that, the discipline of having to say, hey, we're lending to private credit. If there was a liquidity strain and we needed to give these credit lines, what would we have to post? Would the Fed take that or not take that, et cetera? And I think that's a good discipline to do to avoid having to come after just rescue everyone. That also relates a little bit to the leverage lending question that always comes up in all the discussions of regulatory arbitrage. It was clear that the leverage lending clampdown of the Fed has spurred a lot of this reshuffling again. And once again, I think it's a similar thing. If you just have the regulators work through the banks to get them to pre-position some stuff, or to just put more discipline on those individual loans, that might help the situation. And someone mentioned earlier that Dan Tarullo had suggested something related to this as well. I forgot what that comment was. Oh, I'm sorry. I just want to make one more thing about what you, Steve, to your point, that a lot of people again say, as you say, all of these non-banks are safe because they're highly capitalized now. Safer because they're highly capitalized now. So one issue, of course, is whenever there's a boom, that can go down quickly. That's one. But other, as the panelists who know much more about this particular business have been saying, you could just have a liquidity stress there, right? You could have that, even though there's not going to be a default and a failure, you could say for these businesses to continue operation, right? The reason why we have bank regulation is not just for failure, it's for banks to continue as intermediaries. And if you have these sort of big stresses that require funds, we want to make sure that the banking system is able to do that. And that comes back again to the prepositioning of collateral to make sure we've got the discipline to get there.
We're just about out of time, so I suggest we just have, if you have concluding comments, Hugh, do you want to come this way? Gosh, okay. Here, I'll give you a question then.
If you want to go,
so what?
Well, I was going to say, I can give you my best Volcker story if you like.
Well,
so going back to where Jim and I are, that this is potentially as consequential as the Nixon shock. Obviously, many different differences. But I don't know if you were, Christine Harper co-wrote his memoirs, and she's really great book. In 71, when obviously you came off a gold standard, Nixon also imposed a 10% import tariff on the rest of the world. Canada, though, currency was free floating at the time, so therefore they shouldn't really have received any tariffs. But of course, there was some rough justice to your closest partners. But in the document, Nixon and particularly Connolly wanted to also impose tariffs on autos and auto parts in Canada. Nixon, along with the State Department, were really unhappy about it. Volcker and the State Department were really unhappy about this, and they discovered the piece about the Canadian auto tariffs was on the last page of the press release. So he sent someone down to the media room and tore off the last page of every media release. And therefore, the auto part tariffs never went through in 71.
Wow.
And so even Volcker then knew about the boundary problem. And I think this is an important point.
I wonder if we can
comments.
Sorry,
no, I'm just
no,
thinking,
finance.
can we turn off his Truth Social account?
That's anything?
No, I think that's it.
Okay. All right. Well, thank you very much. And we look forward to the rest of the day.